A change in the QE weather will impact savers. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Today we consider the emerging pressure on the 1/3 of Australians who are savers and who we think are getting a really poor shake of the sauce bottle at the moment. And by the way, if you value the content we produce, please do consider supporting our efforts. You can make a one-off donation via PayPal, here is the link, or consider joining our Patreon program. Again, here is the link. And we really appreciate your support to help us to continue to make great content. And the links are also in the comments below. Towards the end of 2018, all the talk was on central banks lifting interest rates to reverse quantitative easing as they reduced their asset purchase programs and money printing. And of course, that would lift interest rates to more normal levels. For example, US monetary policymakers bulked up their books with bank reserves in order to buy trillions of bonds and stimulate the economy further once rates near zero after the 2008-9 global financial crisis. To restore policy to normal, the Fed began shrinking its balance sheet in late 2017 by not replacing as many bonds when they mature. Now, analysts and traders were worried that a shrinking Fed balance sheet is making it expensive for banks to finance loans and trading positions, restricting their lending to companies and to consumers. And investors have been critical, and even President Trump urged the Fed in a tweet in December to stop with the 50 Bs. Balance sheet reductions are capped at $50 billion a month. And then we had the first indicators of slowing growth across many economies. And the stock markets fell significantly at the end of last year in reaction to expected rising rates. So the tune is changing. Fed Chairman Jerome Powell said last month that the bond shrinkage would stop this year, citing banks' growing demand to keep cash with the Fed and technical factors regarding how policymakers currently set rates. Stock markets roared back in the expectation of more asset inflation. And recently, according to a paper from the Kansas City Fed, the US Federal Reserve is considering when to stop reducing bank reserves and start building up its balance sheet once again. Indeed, the Fed may need to hold as much as $1.5 trillion in bank reserves on its balance sheet to properly implement monetary policy, according to the research by Kansas City Fed senior economist A. Lee Smith. That would be relatively small declines from the less than $1.7 trillion now, implying as little as a month or two of reductions ahead. Fed officials have mostly been citing lower estimates of what level of reserves will be needed, some not produced by the bank's own researchers. The effective or average Fed funds rate has been running at around 2.4% since mid-December, which is at parity with the interest rate on reserves. Further shrinking of the US balance sheet has played a significant role in exerting upward pressure on borrowing costs. But the reverse is also true. And in the Eurozone, the European Central Bank has reacted to the threat of recession there with a promise to keep interest rates at historically low levels for at least the rest of this year. The ECB President Mario Draghi recently highlighted the dramatic effect of Donald Trump's trade war with China on Europe's manufacturing industry, and said that he would also offer cheap loans to the Eurozone's troubled banks, which need to roll over billions of euros of funding over the next 2 years, as the ECB sharply cuts its Eurozone growth forecast for 2019 from 1.7% to just 1.1%. Draghi highlighted the cut in the forecasts for China's growth and the uncertainty over Brexit as being among several factors dragging growth down in the Eurozone. And the central bank for the 19 euro nations said that it would launch a series of targeted long-term refinancing operations, or TLTROs, in September. These are to run until March 2021 to help banks roll over the 720 billion euros of ECB loans and to ward off a credit squeeze that could deepen the economic slowdown. And the Italian government was one of the main beneficiaries. The interest rate it pays on its debts, which are largely in Europe, were reduced by traders. And Italian banking stocks rose by as much as 1% immediately after the ECB decision was announced. Draghi said that the ECB Governing Council judged the prospect of a recession to be very low, after a move by governments to bolster their economies this year. And adding, our actions increase the resilience of the Eurozone economy. And in London, a Bank of England official opened up a split on the Monetary Policy Committee following comments that the UK Central Bank was under little pressure from inflation to push up interest rates and would most likely be forced to cut the costs of borrowing should the UK crash out of the EU in the next few weeks. Previously, the bank had said that its response to a chaotic exit would not be automatic because a fall in the value of the pound and the imposition of tariffs on trade could push up inflation, making the case for a rate hike. But, echoing Draghi's dovish comments, she said, in my judgment, a situation where the negative demand effects outweigh those other effects is more likely, which would necessitate a loosening in policy. And of course, China is already stimulating their economy. And in Australia, we know that lower rates and QE are both on the table. So let's go back to some fundamental economics, namely John Maynard Keynes. Keynes was an English economist and author who did groundbreaking work in economics in the early 20th century when trying to understand the Great Depression. The theory he popularised and named Keynesian theory has been a strong influence on the so-called demand-side economic policy, and its essence is a simple thought. Keynes argued for increased government spending and lower taxes to stimulate economic activity, especially during times of dire economic hardship. But this has evolved into the view that it is possible to optimise economic performance by frequent changes to government monetary interest rates and fiscal policies, taxes. But the bit which people miss is the other side of the plan: run surpluses during good times. Politicians prefer to offer election-winning tax cuts rather than saving in the good times. Costello and Howard, please note. And now we're in a situation where those calling the shots, the global monetary gurus, are resorting to Keynesian remedies continually. As a result, the impact is being blunted to the point where interest rates keep being driven lower, debt is rising uncontrollably, and more QE looms again. In the EU, interest rates have plummeted over the last 10 years to near zero, or even below. And this has made it nearly impossible to stimulate a significant return on capital during a slowing economy, with shrinking savings and rising debt levels. Now, according to Keynesian theory, reducing interest rates is a way to borrow from the future demand in order to prevent a recession today. But when interest rates reach zero, or even worse, linger in negative territory, it is safe to assume there is no more future demand left that can be brought forward to today. Plus, when interest rates reach zero, after a while, capital gains disappear, and the only way to maintain consumption is to start consuming the system's existing stock of savings. At this point, someone who has saved for their retirement must stop living off the return from their capital and start living on the return of their capital. Value is eroded. And we've already seen a horrid shift of risk from final benefit super schemes, though some public servants still benefit, to savings completely exposed to market risk. As savings rates fall, people are forced to shift to more risk-laden alternatives in a quest for income. And yet savers in Australia just seem to happily bear this. So I ask myself, why are they not more vocal? In France, one of the triggers behind the current protests was the French government's decision to stop the indexation of pensions to the French inflation rate. The low interest rate environment means that the stock of French savings is currently insufficient to provide adequate returns to retirees. So to maintain French pensioners' purchasing power, the only other option for the French government would have been to raise taxes on working people. But at this point in France, higher taxes are both politically and economically impossible. So as we approach zero bounds, it seems to me the Keynesian trick of bringing forward tomorrow's consumption to today is no longer an option. And so savers will get crushed. And now there is a new theory which just says keep printing money for governments to spend, even when savings don't allow for such spending. And that is called modern monetary theory, or MMT. Expect to hear much more of this ahead, but my point today is it is savers who are bearing the burden of the current monetary and fiscal policies. And it's time for the 1/3 of households to find a voice before it's too late. Finally, a quick reminder that our next live event will be on Tuesday the 19th of March at 8 p.m. Sydney time. As usual, we will take questions live via the chat, or ahead of time you can send me questions via the DFA blog. The links are below. I look forward to seeing you then. And if you found this post useful or informative, please like it, add a comment or a question. I read them all. And importantly, please share it via your social media channels. And if you've not yet subscribed, please ring that bell to receive alerts for future posts. And if you have already subscribed, many thanks. I really appreciate your support and participation. I'm Martin North, the Principal Analyst of Digital Finance Analytics. Many thanks for watching, and I'll see you next time.